Good afternoon, everyone. This is an oral argument on the cross petitions of John J. Asoff, CPA, and Darren M. Bennett, CPA, and the Division of Enforcement for review of the initial decision of an administrative law judge. A total of 40 minutes has been allowed for the argument, with 20 minutes allocated to each side. Respondents will argue first and may reserve time, I think this has been discussed with you, for rebuttal. I understand that respondents have agreed that they will divide their time 20 minutes each and equally, and that Mr. Curtis, on behalf of Mr. Asoff, will speak first. So, Mr. Curtis, on behalf of Mr. Asoff, do you wish to reserve any of your time for rebuttal?
I do, Commissioner. We would like to reserve 1.5 minutes, possibly 1 3/4.
Okay. Should we make it 2 or? Okay.
Well, I'm all for 2. I'm afraid also that I only have 10 minutes, although I certainly would be happy to take 20. We're splitting it 10 each.
Yeah, 10 each, and then 2 minutes for rebuttal each,
you.
I think, is what I understood. But
That's what we're working towards.
very good.
Thank
You may
you.
proceed.
Good afternoon, Commissioners. I hope you can hear me. My name is George Curtis, and I represent Mr. John Asoff, one of the respondents here. With me today is Mr. Asoff. John, would you stand up? And Ms. Monica Losman, my partner. In this portion of respondents' presentation, I want to focus on the central premise of the initial decision. And that premise is that in 2008, fair value estimates had to be adjusted downward to reflect declines in market prices from the most recent appraisal to year end. It had to be lessened. The decline had to be noted according to the initial decision because of the extraordinary market circumstances at the end of 2008, the crash. In other words, the decision creates a liquidation accounting standard rather than fair value standard under GAAP. And therein lies the error. This incorrect central, just don't charge me for the time. This incorrect central premise is the filter through which the facts of the audit are viewed. It causes the decision to judge Mr. Asoff and Mr. Bennett under a non-GAAP standard, without notice and retroactively. And as a consequence, the decision ignores substantial evidence that Mr. Asoff and his team did their job. The professional literature could not be more clear. Under Statement of Financial Accounting Standard 157, a fair value measurement assumes that the asset or liability is exchanged in an orderly transaction, and an orderly transaction is not a forced transaction, for example, a forced liquidation or distressed sale. Perhaps most directly relevant to this presentation today is the guidance offered by the Office of Chief Accountant, dated September 30, 2008, to interpret the fair value accounting standard in the context of the then current severe market crisis. As you may recall, and I know you are all familiar with this, Lehman Brothers had just declared bankruptcy earlier in September. The international financial markets were in extraordinary disarray, and the government, including the Commission and its staff, were struggling to maintain stability. One of the central concerns of market participants in that context was whether fair value accounting required the value of assets to be marked down to crisis-level pricing. The Office of Chief Accountant in its publication called that the most urgent question in this current environment. The answer of the OCA was clearly no, and I'm quoting, "The results of disorderly transactions are not determinative when measuring fair value." And again, distressed or forced liquidation sales are not orderly transactions, and thus the fact that a transaction is distressed or forced should be considered when weighing the available evidence. To honor this guidance, Mr. Aesop and his team obtained and assessed all available evidence regarding the bank's impaired loan estimates and the process by which they were developed. In accord with AU 342, Mr. Aesop and his team tested the process by which Tier 1 assessed fair value and impairment in the context of the individual circumstances of each impaired loan or lending relationship. Their goal was to obtain evidence that management followed GAAP in considering the available evidence and considered changes in circumstances as to each loan between appraisal date and year end.
Mr. Curtis, may I just interrupt you for a moment on your interpretation of FAS 157? I should have interjected a moment ago, but are you contending that in turbulent markets under FAV 157, you have to ignore changing market conditions?
No.
All right, what are the precise parameters?
The precise parameters are that turbulent market conditions, foreclosures, are not determinative of fair value. However, the registrant and the auditor considers the total economic environment and uses that information to determine whether the fair value assessment by the registrant conforms or at least is in accord with the overall performance of the market.
So the deteriorating market conditions are taken into account. They aren't determinative of fair value in terms of, yeah.
And that's the fair value point is the critical one. For instance, Mr. Aesop and his team obtained and tested the FAS 114 templates each quarter and at year end. As recognized by the decision, these templates represented a qualitative and quantitative review by management of each of the impaired loans in the portfolio at each quarter and at each end. Those templates were significant audit evidence for Mr. Aesop and his team. They summarized in some 20 line item entries the major assumptions by management as to a particular loan or lending relationship. And over quarter to quarter to quarter, those assumptions changed or were modified by management. The auditors tracked that. The auditors confirmed that the information in these templates were further supported by the loan files and other relevant information available to Tier 1. They observed that Tier 1 reviewed all available evidence of fair value and weighed that evidence, among other factors, in accord with fair value guidance. They saw a process that was functioning. Nevada loans in the second half of 2008 continued to be impaired. Significant losses were recognized on Nevada loans in the second half. For instance, approximately $12 million in losses in the last 2 quarters. They obtained management's analysis of the year-end market conditions. Tier 1 management provided a 40-page single-space analysis of the markets and the methodology they used to assess impaired loans. The auditors reviewed that, and Mr. Aesop, that study also quoted third-party sources, such as Case-Shiller and QuickData. The auditors got those studies and reviewed them. Again, this is part of their study or their analysis of the overall environment, which it goes beyond fair value. It is showing what is this market doing right now. They assessed the results of Tier 1's impairment process and saw that significant loan losses had been recognized in 2008. Indeed, Tier 1 booked a 30% decline in its Nevada impaired loan portfolio by year end.
Mr. Curtis, I want to insert, because we're almost out of time. What professional responsibilities, if any, do you think your client had with respect to the 2 appraisals that were received in 2009?
In 2009.
And did those appraisals call into question the sufficiency of the company's assessment of loan losses? And I just want to, this is really what I'm getting at. Why didn't the appraisals raise a red flag for your client?
Why did they not?
Yes.
Yes, because first, let me give you an example. Celebrate 50, as to which there was a new appraisal received in 2009. In its year-end FAS 114 template, the auditors noted that a new appraisal was expected. By year-end 2009, Tier 1 had reduced the value, that is, booked a loss of 55% of that loan's value. When they saw the downward process of Celebrate 50 continue, it was no surprise. This had happened through the entire course of 2008. The new appraisals confirmed the decline that the auditors knew was coming. The auditors knew there were losses in this market. Their challenge was to assess the fair value of the loans in view of those losses. So, and by the way, you mentioned 2 loans. I think there might have been 4. One went up, the Cush loan went up, the others went down. This is a total of $4 million in an impaired loan portfolio that I think came to something on the order of $150 million, but I may be off by about $100 million. I can get that for you right here.
Thank you. Your time has expired. Your initial time has expired, Mr. Curtis.
May I ask, in answering the questions, that I at least
Take another minute. Take another minute.
I'll take another minute. Okay. Those declines made sense to the auditors. It was consistent with the Case-Shiller report of 32%. The Nevada portfolio went down 30%. A 22% loss was booked. And our concern with this decision is that it takes into account none of these procedures. It doesn't recognize fair value accounting and its significance to the auditors. And in fact, in one footnote, in the footnote 35, the decision cites to the text of FAS 157 and the OCA. It never applies them in its entire decision. More importantly, it doesn't apply it to its own decision. And in fact, had it, it would have realized that what it espouses is not fair value.
Yes, this brings, what audit procedures did your client undertake to evaluate the impact of management's use of potentially stale appraisals, or that management might overvalue collateral?
Be overvaluing collateral?
Yeah, be
Yes, thank you.
overvaluing the underlying collateral in the portfolio.
Basically, several stages. They reviewed every one of the quarter's 157 analyses. They tested those against the loan files. They reviewed the market analysis under L30A. And may I just say, stale appraisals are not recognized under GAAP. There is no particular definition of stale appraisals. An appraisal is appropriately a data point. As the division itself said, in separate proceedings involving Tier 1, a recent appraisal is not necessary to the appropriate determination of fair value. So what the auditors did was they were looking at the individual loan assessments by management. That was the critical matrix for what the auditors were looking at. Professor Thakur and the initial decision simply say, we will apply an across-the-board mean decline, mean statistical decline by market. That's not GAAP. You have to satisfy yourself that management was reviewing each loan and doing so meaningfully, and that's what the auditors saw and recorded in their work papers.
So you're saying there was no concern that stale appraisals were no longer representative of fair value?
Oh, it wasn't. I'm sorry, I don't mean to speak in the negative. The auditors took full note of the appraisals. They took note that they played a role in the process. But it did not, as an auditor, you don't have to be concerned that the appraisals were not reduced because of market crises. That's not a fair value consideration. You are concerned to understand what does the market look like at the end of the process.
No, that's fine.
Okay.
Thank you very much, Mr. Curtis.
You're very welcome. Thank you.
Thank you. Mr. Bendinger, on behalf of Mr. Bennett, I guess you have 8 minutes initially? I do. Please proceed.
Good afternoon. My name is Gary Bendinger, and I represent Respondent Darren Bennett. Mr. Bennett's here today. Darren, can you stand up? And also with me is my partner, Mr. Burke, Kevin Burke. At the outset, I'd like to recognize that auditors that pose a threat to the Commission and the commission's processes should be sanctioned. But this record does not disclose and does not show that Mr. Bennett poses any threat to the processes of the commission, nor does the conduct of Mr. Bennett during the course of the 2008 audit come close to the egregiousness of the conduct of the very few managers who have been sanctioned by the commission, and hopefully, time permitting, we'll talk a little bit about that. The record shows that Mr. Bennett worked tirelessly alongside the engagement partner, Mr. Asoff, did good audit work, and throughout the audit acted diligently. And we're not aware of a single instance in which the commission has found improper professional conduct by a manager, where the area of risk is properly identified, increased work is done related to that risk, work papers and other documentation are created reflecting that work. There's no information the manager has that he hides or withholds from the engagement partner that could affect professional judgments, that the documentation is there, and moreover, that the work, and this is important, that the work and the professional judgments rendered by the manager are shared with the engagement partner and the concurrent review partner, and not only shared but approved by those partners, and not only approved by the partners based on what Mr. Bennett said, but in the case of Mr. Asoff, based on his own independent review of the work papers and his own thorough audit work. And at the end of the day, all of that, as if it were not enough, was supported by the expert testimony at the hearing of Ms. Sandra Jonigan, who is indisputably an experienced bank auditor and a qualified audit expert, somebody that the SEC and the Department of Justice themselves have used in various proceedings. There's been extensive briefing. In addition to what Mr. Curtis said, what I'd like to do, time permitting, is focus on a couple of areas which I think demonstrate the fundamental flaw in the initial decision and why the ALJ was fundamentally wrong doing what she did. First, the initial decision ignores without any explanation the substantial evidence presented by Ms. Jonigan, the audit expert. And there is no consideration, not a single word in the ID addressing her substantial testimony and evidence that Mr. Bennett met professional standards and that the audit documentation was sufficient under AS number 3. And the ALJ, having ignored and disregarded that evidence and failing to explain why in the initial decision, has improperly and impermissibly substituted her hindsight judgment for that of the experienced auditors and Ms. Jonigan. And second, as the record showed below, Mr. Bennett is a competent auditor and no threat to the processes of the commission. And when you look at the initial decision, you don't see what you would expect to see. You see no indication of how he departed from professional standards or the degree of departure from professional standards, which you would ordinarily see and would serve as a foundation for any finding of highly unreasonable conduct. That is completely absent. You also don't see any identification, any description of what a reasonable audit manager would have done under this turbulent economic times that he didn't do. And finally, you do not see in that initial decision any identification of a single, simple, obvious step that should have been done or could have been done that was not done. So for all of those reasons, the finding in the initial decision of highly unreasonable conduct and multiple instances of unreasonable conduct is not supported by the evidence.
Mr. Benninger, can I ask you just one factual question? And this is on the memo that talks about the tier 1 loss estimates and has the phrase in it, the market conditions have not materially deteriorated. Is that just a mistake in the memo that was missed, basically, in reviewing
I'm
the
sorry,
memo?
Chair White, to interrupt. I thought
No,
that's
yeah.
anticipated where you were going, and it's plainly a mistake. I mean, when you look at all of the other work papers, starting with the planning memo and finishing with the completion memo, as the ALJ found, they plainly understood markets were deteriorating. And Commissioner Stein, to your question, and Chair White's, that information wasn't ignored by the audit team. In other words, we'd have a different situation here in terms of unreasonable conduct or highly unreasonable conduct. If you had those turbulent economic times in 2008 and Mr. Asoff and Mr. Bennett ignored them, and looked at the financial statements and saw what the company had estimated in terms of losses on the impaired loan portfolio and did no work, just accepted the estimate, then we'd have a different discussion to be having. But that's not our record. Our record is 180 degrees from that, right? We've got a situation where the auditors plainly knew conditions, markets were deteriorating. It's reflected in the audit documentation. They didn't ignore it. They decided in that area there was a heightened risk. There was an increased risk. They didn't ignore the increased risk. They planned to do more work, and not just generally on the audit, but they planned to do more work related specifically to the company's estimate on these impaired loans, which is only one component of the ALLL. And by the way, the ALLL being one account on a balance sheet, out of $3.3 billion in assets, Tier 1 had about $2.8 billion in loans. Of those, $2.6 billion were what called FAS 5 loans and evaluated under FAS 5. There's no criticism of that work. So you're talking about a $225 million FAS 114 impaired loan number, and what Mr. Bennett and Mr. Asoff saw during the course of the audit, as Mr. Curtis just said, is what you would have expected to see with markets deteriorating. They had recorded during the course of the year about $57 million in losses on those FAS 114 impaired loans. That was consistent with what they would have expected to see. But they just didn't accept the estimate of management and say, thank you very much, audit by inquiry, and move on. That's not what they did. It's not what the record reflects. They did a lot of
Interrupt for
work.
just one other question, at least from me, and that is to talk a little bit about the controls, the effective controls over financial reporting, as the controls either did or did not relate to current appraisals or updating of stale appraisals. I'd just like to understand your position on that, whether there were such controls, whether there didn't need to be such controls, et cetera.
Fair enough. Let's start with there were such controls. The record reflects there were such controls. Mr. Bennett testified to the controls. Mr. Asoff testified to the controls. Ms. Jonigan came in, having reviewed all the work papers, saw that there was a control. There were certainly controls on the front end with respect to where appraisals obtained.
That's origination, though, right?
At origination, and there were also controls at the back end, as the record reflects, that were tested, and Ms. Jonigan found the work was sufficient and supported the auditor's judgment. And that control being this, that you had David Francis, who is the chief asset executive, who put together these 114 templates, which was the part of the company's process to update their evaluation and analysis with respect to collateral valuations. Even the division's own expert conceded that the control existed and would be appropriate and adequate if you had somebody other than the person preparing that analysis review it. And the record is not in dispute that Mr. Kellogg was the controller of the company. He reviewed the 114 templates. He reviewed the estimate. And more than that, so that's a control at the end of the process, which addresses specifically the risk of overvaluation of collateral at year end. But more than that, that wasn't the only control, because we understood the process included, among other things, you've got an asset classification committee where you've got 11 senior folks from the company who on a regular basis get reports that are related to each of these loans. And as we understood it, and it's got confirmed by the audit evidence, during the course of those meetings, they would go through each of those loans and make their own assessments and judgments and evaluations. So we understood there was a control, there was a process, the process was working. There was no dispute below that the approach the audit team took was the appropriate approach, that is, test the process. It's specifically set forth in the audit standards. The division's expert conceded that. It was an appropriate approach. We did it. The documentation shows that. Ms. Jonigan said at the end of the day, look, the auditors did what you would expect them to do. I saw the documentation I would have expected to see. It met AS number 3. And at the end of the day, Mr. Barron she would like to have had on one of her, Mr. Bennett, she would like to have had him on one of her engagements and somebody that she could have relied on. I'm seeing my time's up, but I'm happy to respond.
I'd like to ask a question, Chair White, if that's okay. There's this tension, right, basically about identifying the internal controls that your client tested, which had to do with managerial review of the loan losses, and your client's assessment that there was a high risk that management might intentionally misstate the loan loss estimates. And this goes to OTS's, downgrading in the fall, of that year. What audit procedures were undertaken to ensure that there was no reliance on management's assessment when it was identified that there was a high risk of misstatement in the assessment? So it's not just one manager or even that committee. They all had an incentive at that point to stay with some stale appraisals, to stay with collateral, assumptions that would help the bank overall at that point, given what was happening.
Fair enough, Commissioner Stein. Let me try and respond to that question directly in this way. Fundamentally, during this period, and with the recognition of the risk that you've just acknowledged, among other things, what the audit team was concerned about and what they addressed during the course of the audit was there a management bias that existed at the time that was going to affect their valuation of this collateral, right? So the audit team acknowledged that up front, and over the course of the audit, they had that in mind as they were doing what they were doing and looking at the results of their work. And what they saw before the audit report goes out the door, right, before the professional judgments are finally reached, is you had a company that, number one, to the extent they had appraisals that were before the first 4 or 5 or 6 months of 2008, those appraisals in most cases, if not all, had been discounted heavily. In some cases, 30, 40, 50, 55%, number one. Number two, they saw during the course of 2008 that management, even into the fourth quarter of 2008, was identifying new loans as impaired, which meant, and most of the loss that gets recorded on a loan, an impaired loan, gets recorded when the loan is deemed to be impaired. So by virtue of taking some loans and classifying them for the first time as impaired loans, you were going to see losses recognized, and in fact, that's what happened. Again, that's not evidence of management bias. There were some other losses obviously recognized. Mr. Curtis referred to roughly $12 or $13 million on Nevada loans alone in the last part of 2008. So when you look at the totality of the evidence, what I would say, Commissioner Stein, is they recognized the risk, they planned the audit accordingly, and there's no criticism by the division or the division's expert of the planning for the audit. They intended to do more work related to this risk. The record reflects they did more work. Mr. Bennett alone, spending over 90% more time in 2008 than 2007. And there's none of that, right? They weren't required by professional standards to look at every 114 template, but they did because they understood the risk.
Did they independently test the representations being made by management, the template?
I would say they independently tested through all of that work, but I would also say, Commissioner Stein, that if you look at the standards, there are 3 approaches that the standards permit as appropriate to test management's process that leads to this estimate, and that one of those approaches, and the one that even the division's expert acknowledged, as does Ms. Jonigan, would be the most appropriate and the one mostly followed in markets deteriorating like we saw in 2008, was actually the approach we took, which was to test the process. So there was no dispute, there was a standard. There was no dispute, it was appropriate. There was no dispute, we followed it. The work papers reflect that's what we were doing. And at the end of the day, what the auditor saw based on all of that work was a process that was working and yielding a reasonable estimate. And the initial decision is fundamentally flawed because it doesn't treat at all Ms. Jonigan's substantial evidence. There's no explanation in that decision at all as to why her testimony, given her substantial bank audit experience and her qualifications was not considered. And that violates the Administrative Procedures Act, and that is also inconsistent with how the decisions of the commission have previously dealt with expert testimony.
I'm going to ask you one more before we let you go, at least there may be others by other commissioners. And this is back on the question of the effectiveness of the controls, the back-end controls. I mean, I take it from what you've said, but I'm not sure, you may have more to add to this, that the fact that the controller and that management sat on that committee that did the reviews, that doesn't undermine the effectiveness of those controls?
No, not at all.
Okay.
And I would just add, Chair White, as one final thing before I go sit down. I mean, we certainly, understood the process and tested the process, but it wasn't just relying on what management told us, because at the end of the day, folks looked at third-party market data in an effort to corroborate the reasonableness of what we were seeing and what we were being told. Thank you.
Thank you very much. We'll hear from the division now, Mr. Heinke.
Chair White, Commissioner Stein, Commissioner Pivovar. This case is about the respondent's violations of fundamental responsibilities of an auditor, including the responsibilities to exercise due care, appropriate skepticism, and to gather sufficient competent evidence. It's about those fundamental violations occurring in an area of the audit that was one of the highest risk pieces of the audit in question. And it's about those fundamental violations requiring significant sanctions in order to protect the investing public and encourage more rigorous compliance with professional standards. Now, despite the respondents' attempts in the briefs and in the argument today to make this case about nuanced accounting pronouncements, when the Commission reviews the record evidence of what actually occurred during the 2008 audit, the questions in this case are really quite straightforward. Did the respondents' work over a critically risky and critically important audit area constitute improper professional conduct for purposes of Rule 102E? And if so, were the sanctions imposed by the law judge sufficient? The answer to the first question is yes, and the answer to the second question is no. I'd like to spend my time today talking about the three areas of the audit where the respondents failed in their duties and violated professional standards. First, I'll talk about the substantive audit. I'll also address internal controls and then the respondents' reaction to the newly discovered appraisals after their opinion was issued. And then finally, I'll address the portion of the decision that the division challenges, which is the imposition of sanctions and the appropriate length of sanctions on the respondents. Now, as the Commission knows from the briefs and from respondents' argument, the audit area at the heart of this case is Tier 1's loan losses on its FAS 114 loans. Those loan losses are estimated by comparing the value of the loan, on the one hand, to the value of the collateral underlying the loan. And if that collateral falls below the value of the loan, the bank has to take losses. Now, the audited issue, as the Commission knows, occurred at the end of 2008 and beginning of 2009. And that timing is important because we were in the teeth of the Great Recession at a time where market values, and real estate values in particular, were absolutely plummeting. Even so, Tier 1 valued the collateral on its FAS 114 loans using stale appraisals that weren't discounted to take into account the market declines. Now, Mr. Curtis, during his argument, said that he wasn't contending that FAS 157 permitted ignoring market conditions, but that's exactly what the bank did, because on loan after loan after loan, the bank was valuing these loans using appraisals that were from the beginning of 2008, if not earlier, and in many cases not discounted at all to account for the market declines. Now, that was just one of the red flags highlighting the significant risks related to these loans in this account. Another red flag, as the division points out in its briefs, was the scathing report by Tier 1's bank regulator, the Office of Thrift Supervision. Now, among other things, that report found Tier 1's loan administration practices were inept. It found an extreme level of problems and risk exposure. It found loans with unsupported and stale appraisals. The OTS downgraded Tier 1 from a bank with the highest rating to the bank with the second lowest rating, testimony that the OTS examiner said he had never seen before or since such an extraordinary downgrade in one examination. It meant that Tier 1 was downgraded from a bank that was sound in every respect to one that generally exhibited unsafe and unsound practices and conditions. Now, the upshot of this report, which the auditors knew about, was that there were serious risks related to the very loans involved in this FAS 114 loan portfolio. Now, the reason I talk about these risks and the other risks that are detailed in the initial decision is that they're important for a number of reasons. First, given the risks, I don't think there can be any dispute that heightened scrutiny was required for purposes of the 102E analysis. Now, second, and a related point, under the audit standards, the riskier an audit area, the more care, skepticism, and evidence is required from the auditor. And that's particularly true here where the auditors knew that management had an incentive, they conceded this at the hearing, that management had an incentive to overstate collateral values and therefore understate the loan losses. Now, third, because of the risks, the FAS 114 loans themselves were critical to this audit. As Mr. Asoff conceded at the hearing, and as the law judge noted in the initial decision, in light of the risks, the respondents needed to perform sufficient audit procedures over and gather sufficient evidence regarding the FAS 114 component of the loan loss account. And if they didn't do either of those things, the auditors wouldn't have a basis to issue their overall audit opinion. In other words, despite the respondents' attempts in their briefs and at the hearing to talk about the FAS 114 loan losses as just one part of a broader account, or as Mr. Bendinger pointed out, the fact that the division didn't challenge the FAS 5 portion of the account. By their own admission, the FAS 114 loan losses were individually material and critical to the audit. And finally, on risks, the Commission shouldn't be fooled by the respondents' repeated attempts to take credit for recognizing the risks. The idea that somehow the division's case was beat back or the facts didn't come out the way we thought that in fact that the respondents had recognized the risks. The division has never contended that the respondents failed to recognize these risks. The division's point is that in light of the risks, serious audit scrutiny was required of these auditors. It was required, but it wasn't given, because when you look at the audit procedures that actually were performed, those procedures are seriously lacking. In fact, as I'll discuss more in a moment, the respondents don't even defend the documented audit procedures. Instead, they rest their case almost entirely on work that is outside of the FAS 114 audit work papers. But let's talk about what's actually in the work papers. Now, there's a specific work paper, the FAS 114 memo, which is where the respondents have conceded they would have documented their material audit procedures over this account. In other words, despite the respondents' attempts to point to other portions of the audit files, or more notably, to procedures that aren't documented at all, they can't escape the basic fact that there's a work paper that actually documents what occurred during the audit. And as the law judge correctly observed, that work paper reveals procedures that fell well short of the professional standards. Now, the law judge's analysis of those procedures is correct and it's compelling, and I won't repeat each point here. I'll simply highlight for today the flaws in the key procedure at issue. Again, the core risk with these FAS 114 loans is that the collateral underlying the loans would be overvalued, meaning the losses would be undervalued. Now, Mr. Curtis says that the auditors gathered all available evidence in order to test that risk and to evaluate that portion of the audit. That's not what the work papers show. The work papers say that to address this risk, the auditors first looked at the appraisals to see if they were a year old or less, in which case they deemed them current. If and only if the appraisal was older than a year, then the auditors inquired of Tier 1's management to say, is this value still reasonable? Do we need to discount it? And if not, why not? Inquired of management. Those procedures were completely inadequate. As the law judge noted, the assumption that appraisals approaching a year old still captured the fair value of property was completely inconsistent with the market conditions in 2008, which showed extraordinary real estate declines, sometimes over 30% throughout the year. And on top of that, simply asking management if these stale appraisals were still reasonable indicators of value and accepting their answer at face value is the definition of the failure to apply appropriate skepticism and gather competent evidence. Commissioner Stein, you asked whether there was independent testing of these management representations. There's no indication in the record that there was. When you look at the work papers, what the records show, not just the FAS 114 memo, but template after template after template of the FAS 114 loans themselves, showed that the auditors looked at the appraisal and sometimes asked questions of management and occasionally wrote down the answers of management. But it doesn't go further than that. There's no indication that they demanded independent, competent evidence to say, on a 10-month-old appraisal where value had fallen 30% from the date of the appraisal to the date of the audit, that there was any independent evidence to corroborate that valuation estimate. Now, it's telling that even the respondents don't attempt to argue that the procedures reflected in the FAS 114 memo are sufficient. Instead, as I mentioned before, the respondents rest their case on several procedures that they claimed informed the 2008 audit, but are notably absent from the FAS 114 work papers. Now, the flaws in these procedures, both the evidence that they weren't performed and the evidence that they weren't sufficient, is detailed in the initial decision, and I won't repeat each point here. For now, I'll focus where the respondents and Mr. Curtis particularly focused, which is on FAS 157. Now, FAS 157 is the gap pronouncement on fair value. There's no dispute about that. But the respondents essentially argue that FAS 157 would allow Tier 1 and the auditors to rely on these older, undiscounted appraisals because of market distress throughout 2008. In fact, the respondents claim that the initial decision is fundamentally flawed because it misinterprets FAS 157. But the real fundamental flaw is the complete lack of evidence that this current interpretation of FAS 157 played any meaningful role in the respondents' audit of the FAS 114 loans. There's no mention of the concept in the FAS 114 work papers. And in fact, as the law judge notes, there is a separate work paper on FAS 157 that lists accounts and disclosures that FAS 157 applies to, and it's silent about FAS 114 or the ALLL as a whole. Throughout 2008, the record evidence shows that the auditors, that the respondents were telling Tier 1, not that current appraisals were no longer valid indicators of fair value, but instead they were encouraging Tier 1 to get updated appraisals and that current appraisals were the best evidence of fair value. That's what the investigative testimony showed that the auditors were telling, and other record evidence, that the auditors were telling Tier 1 throughout 2008. That's completely at odds with the respondents' current claim that they viewed appraisals as not indicative of fair value because of liquidation issues. On top of that, this FAS 157 concept wasn't mentioned during multiple days of investigative testimony. It wasn't in the respondents' Wells submissions. Now, importantly, the FAS 157 point's not a semantic one. The division is not criticizing respondents for using the term FAS 157 versus the term fair value. That's not the point. The point is that the entire investigative record undercuts any claim that the FAS 157 concept that the respondents now advance was used during the audit. But let me say, even if the respondents' current interpretation of FAS 157 had been used, it wouldn't save the audit. FAS 157 doesn't mean what the respondents contend it means. Now, the respondents claim that the division is flawed in its interpretation of FAS 157 and that the decision created a liquidation accounting standard. In fact, in Mr. Asoff's reply brief, he argues, and I'll quote his brief, he says, the division's proffered interpretation of FAS 157, that fair value is measured through a hypothetical transaction that assumes exposure to market forces, renders entirely meaningless the fair value definition in the standard itself. But that's precisely what the standard says. In defining fair value, FAS 157 says the transaction is a hypothetical transaction at the measurement date, and it also says that the transaction itself is an orderly transaction, but that assumes exposure to the market for a period prior to the measurement date. It's in paragraphs C25 and C26 of the standard itself. FAS 157 doesn't say you ignore the market. FAS 157 explicitly says you consider it. There's nothing in the September 2008 OCA guidance that says any differently. And in fact, that definition is consistent with the numerous PCAOB auditing standards that require an auditor to consider the market.
Can I ask you what your interpretation would be of what should have been done here by the auditors under that interpretation? In other words, considering market conditions, what should they have done they did not do?
Well, I think at the very first step, I think when the auditors saw appraisal after appraisal after appraisal that were so significantly different than what the market conditions suggested, they needed to apply skepticism and care and go to management and demand competent evidence to say, why is it that, for example, on a 9-month-old appraisal, 10-month-old appraisal in Las Vegas with no discount, what is your evidence to suggest that that value still holds? Now, we didn't see any of that evidence in the record. Could it have existed? It's hard for me to imagine it could. It's hard for me to think that on loan after loan after loan, Tier 1 happened to be the one bank who had picked properties that weren't losing their value throughout 2008. But that's what you would expect from the auditors, is when management said, we're comfortable with this 15-month-old appraisal in South Carolina on the Streamline construction loan, an October 2007 appraisal in South Carolina, one of the hardest hit markets. We would expect the auditors to go to management and say, what is your evidence to suggest that this valuation decision is still reasonable? So I think that's what we would expect from the auditors, is demanding more than simply representation of management, that these appraisals were still reasonable indicators of value. And again, as I think the division's expert noted at the hearing, it might have been appropriate for Tier 1 to make some adjustment to appraisals to account for market declines. The division's not contending that that would be improper. What's improper is to completely ignore the market declines on loan after loan after loan with stale appraisals. And I'll note, and I expect the respondents may argue, that there is an indication in management's loan loss memo where it talks about appraisals being liquidation appraisals. But if you keep reading what that memo says, it very clearly says that the way Tier 1 is going to deal with this concern about liquidation appraisals is to discount Nevada appraisals older than 6 months. That's what management said it was going to do. It is undisputed they didn't. On loan after loan after loan, the auditors saw management say, we have concerns about getting new appraisals, so we're going to discount appraisals older than 6 months, and then on loan after loan after loan, they saw they didn't do it. That's just one more red flag to the auditors around this account. Now, on a related note, Mr. Bennett repeatedly claims that the initial decision is flawed because it imposed some new requirement to obtain current appraisals. I want to be very clear. That's not what the initial decision did, and that's not what the division is arguing. The point is that given the significant audit risks, the respondents were required to do more than simply ask Tier 1's management whether the collateral values represented by stale, undiscounted appraisals were reasonable. That's the audit failure. It has nothing to do with creating a new standard for current appraisals. It has everything to do with the fundamental requirements to exercise care, skepticism, and gather competent evidence. Now, Mr. Curtis also mentioned the comparison between the market declines in Nevada being approximately 30% and the charge-offs throughout the year being approximately 30%. And I want to address that briefly. As a threshold matter, again, that procedure is not documented in the audit work papers. If it was indeed such a vital and fundamental part of what the auditors did, the audit standards say you would write it down. In fact, AS3 couldn't be clearer to say that if a procedure or evidence isn't documented, it casts significant doubt on whether the procedure occurred. But again, even if the procedure had occurred, it wouldn't be sufficient.
You're referring to the Kellogg conversation, in part?
That's correct, Chair
I mean,
White.
is it the division's position that that conversation did not occur? I understand it wasn't documented, which, you know, is an issue. But is it the division's position that that conversation did not occur?
The division's position is that the record evidence suggests the conversation didn't occur. It's not just that it's not written down in the FAS 114 memo or in the work papers. There's not some other contemporaneous evidence of the conversation occurring. There's not an email.
Although
there's
wasn't
not
that
notes.
adjustment actually made, in fact made, the one that was said that was made?
The 30%? It was. So it is correct as a matter of fact that fortuitously there was about 30% charge-off in Nevada, and that lines up roughly with the Case-Shiller decline. I'd note, as we point out in the briefs, I use the word fortuitously for a reason. When you look at other states, which is what the division's expert testified you would do if you were going to do this trend analysis, Arizona shows it's down 12, or there's 12 or 15% charge-offs when the market's down 33%. And Nebraska shows something on the order of 25% charge-offs when the market's not down at all. So the fact is that those numbers lined up, but they didn't line up in some sort of overall way where the trend analysis would be persuasive audit evidence. The other thing I would note is, just to make clear my answer, you could do the calculation to get to the 30% from information in the work papers, but the work papers don't evidence anything to suggest the calculation was actually done. Now, recognizing my time, I want to turn to the piece of the initial decision that the division challenges, which is the sanctions imposed by the law judge. Now, the public interest factors and the public interest in general compel more significant suspensions than the 1-year suspension against Mr. Asoff and the 6-month suspension against Mr. Bennett. Their misconduct occurred in one of the highest risk areas of the audit and in the face of repeated red flags. They failed to follow some of the most fundamental professional standards, and they did so repeatedly: substantive audit, audit of internal controls, and response to the newly discovered appraisals. They didn't do their jobs. They didn't do what the commission expects of an auditor that practices before it. Their conduct poses a risk to the commission's process and to the investing public. Now, Mr. Bennett argued that there was no indication of what he should have done. But I think that answer is self-evident. What an auditor should do when faced with a critically risky account and loan after loan after loan valued with a stale appraisal is demand evidence. Demand evidence. Exercise skepticism. Probe your client. That's what we expect from auditors in critically risky and important accounts, and that's not what occurred here. I see my time's expired unless there's any
I think
questions.
there may be a question
I have
or
some
two.
questions, yeah, on the
Please.
sanctions, right? So you're arguing for just lengthening the suspensions from what the ALJ imposed, not for a permanent bar with the right to reapply.
That's correct.
Okay.
The division has argued for 3 years for Mr. Asoff and 2 years for Mr. Bennett.
Okay. Now, the ALJ, in coming up with the suspension lengths, applied the Stedman factors. Do you agree or disagree with the appropriateness of applying the Stedman factors?
So I would note that I have not found a commission decision that formally applies the Stedman factors in a 102E analysis against the auditors. So there are commission decisions in 102E cases against attorneys, for example, and that's cited in the division's brief, where Stedman's applied. In the commission's, and there's certainly, to be clear, in ALJ decisions, they often apply the Stedman factors. I did not find a decision where the commission applied the Stedman factors. It would certainly be appropriate in the sense that consideration of the public interest is, I think, what informs the commission's decision. So the division is not suggesting the commission shouldn't, but again, I don't think there's binding precedent one way or the other.
So what I'm getting to is,
Sure.
so on what basis do you think the ALJ erred? Was it in the use of the Stedman factors, whether to use those factors, how they were applied, or was there some other legal error that the ALJ made for you to make your argument that they should be longer?
Sure, I would say two things. First, I think primarily it was in how they were applied. I think that the conduct demonstrated here in one of the highest risk, critically important audit areas, and again, in multiple pieces of that audit, substantive audit, internal controls, response to new appraisals, would show conduct that's egregious. It would show conduct that was repeated in the audit. And again, there's no indication that the respondents have recognized the wrongdoing of their conduct, which again counsels for higher sanctions. So it's in the application rather than the use, full stop.
Okay, and there was no other legal errors that the ALJ made in coming up with the determination?
That's correct. It's just in the application thereof.
Okay, thank you.
Let's just do one more on this. How should we consider, how does the division consider, in terms of relevance, Mr. Bennett's relatively short, as a senior manager, but also a fairly short tenure, as I recall from the record, as a senior manager? How should we factor that in?
Sure. I think first I would take a little issue with the premise in the sense that Mr. Bennett, while more junior than Mr. Asoff, was a 7-year auditor with KPMG, 5 years on the Tier 1 audit, 30 other audits under his belt before this one. So this isn't the auditor that's 6 months out of school. This is an auditor with significant experience. But to answer the question directly, I think the way to take that into account is the division's recognized there should be a distinction in the length of the bar. It is perfectly appropriate to impose a shorter bar on Mr. Bennett But again, the idea of no bar at all or an insignificant bar wouldn't be appropriate.
Thank you.
Thank you.
Thank you very much. Mr. Curtis, your rebuttal?
Thank you. I'd like to use this opportunity to address some record misstatements by the division, starting with the issue of bias and the L32 memo, and I'd like to address Commissioner Stein's question regarding appraisals. On L32, the commission describes that, the division describes that, pardon me, as a 2-page memo. It's a 56-page memo. The 54 L114s are part of the L32 memo. When Mr. Hanke says that the auditors did not see any reduction in value on these loans during 2008, that's not accurate. The auditors saw in the FAS 114 templates and tracked to the loan files $55 million of charge-offs. They are noted on every one of the memos. To say that they simply accepted the appraisal and saw nothing more is simply not accurate. Looking at the issue of bias, not only are the factors that Mr. Bendinger mentioned present, but they saw the categorization of loans and the classification of loans that were against the interest of the company if they were to avoid losses. 2 in particular, Town Vista Brothers Sunny, $6 million in loans. The company could have left them in bucket 2 of the impaired loans, not recognized any loss. They did not. They brought them over to FAS 5 and had to recognize $6 million. In the last quarter of 2008, the company, the bank, recognized the loss, the impairment of a $17 million loan and recognized $6 million in losses. I would come back to the sanctions for a moment. The fact of the matter is that Mr. Aesop and Mr. Bennett found a fraud, prosecuted a fraud, and assisted the Department of Justice in doing that. What you have heard described by Mr. Hanke and by Mr. Bendinger and me is a series of issues that required judgment. This is a matter of judgment. This is not just a walk-by audit. There were significant procedures devoted to each one of these things. The key market here was Nevada. Of 13 loans, there were 11 appraisals. They didn't just start or end with an appraisal, even though the appraisals were very much considered. They were looking at what happened to these loans. And as Ms. Jonigan testified, and as a report says, in order to see what happened to a loan, you look at the charge-offs. And this is what she looked at, this is what we looked at. We saw significant adjustments throughout 2008. Thank you.
Thank you.
I have a quick
One second.
question.
Sure,
In 2010, KPMG withdrew its audit report
that's right.
on Tier 1's financial statements for the period ending December 31st, 2009. When was the audit opinion no longer considered accurate? And what factors contributed to this audit failure? Why did KPMG withdraw?
Okay, let me answer that. I don't think
Audit.
I'm going to ratify an audit failure if it's okay with you. What happened was in 2009, as recited by the initial decision, in the third quarter there was a significant booking of losses, $120 million. And that's quoted in the initial decision to say, well, look at this. That's hindsight. The auditors had no idea that $120 million was going to be booked. When they saw it, they refused to issue their 2009 opinion and conducted a series of procedures bringing in independent experts and bringing in their own experts to evaluate what had happened to this company. They drove that all the way through to 2010 when they discovered a document that had been reviewed by the board, known to management and never disclosed to the auditor, which was another set of books. It was basically, these are the losses. And when they found that out, they resigned and withdrew their 2008 opinion. Strangely, the division never mentions that, nor does the initial decision mention that. They're happy to quote 2010 events, but never draw the line to say, well, wait, these auditors reacted just as you'd hope an auditor would. Both Mr. Aesop and Mr. Bennett assisted the Department of Justice in bringing these fraudsters to justice. That's part of what we'd ask you consider.
Do you suggest that the fraud actually interfered with the audit?
Well, ultimately, it appeared that the various representations made and the documents shown had been fabricated, and that an entire set of loan reserves or assessments was being worked separately.
Okay. Anything else? Thank you very much. Mr. Benedinger?
Thank you.
You proceed with your rebuttal. Thank you.
Thank you. Let me see if I can do this quickly. Chair White, starting with your last question, the answer to that is yes. Among other things, during the course of the audit, the auditors formed professional judgments regarding the persuasiveness of certain processes and representations and audit evidence that they were seeing, and the fraud directly impacted that judgment. We now know that. We didn't know it at the time, but we now know that. Specifically with respect to the consensus that we were told and we observed and we believed occurred with respect to the estimate by the AL Asset Classification Committee, we now know is false. And the division has sued former members of management, and those folks are on their way to jail. And by the way, in that litigation, the division took the position that not only were the auditors defrauded, but that appraisals weren't important. Appraisals weren't important. So, when you're out trying to put folks in jail, appraisals don't count. And when you want to take somebody's career away, all of a sudden the date of an appraisal becomes determinative. That's not GAAP, and that's just fundamentally wrong. You ask also, Chair White, is it relevant that Mr. Bennett, 8 years ago when he did this work, was a 31-year-old first-year senior manager? The answer to that is yes. I mean, his conduct's got to be judged under Rule 102E next to others similarly situated. Not somebody that's been auditing for 30 years or 40 years, but other similarly situated first-year senior managers who are dealing with difficult issues in a difficult economic environment. And certainly during the course of that, what the record reflects is he made professional judgments. There's no evidence that he didn't do what he was asked to do. The record reflects he made hundreds of review comments, which shows due care. And at the end, he exercised his judgment with respect to these processes and the estimates. And that judgment was shared with two partners who were experienced, and neither one of them took issue with his judgment. And one final point, Ms. Jonigan on documentation. She is the experienced bank auditor the AS number 3 has in mind when the PCAOB passed that standard. Mr. Barron, the division's expert, by his own admission is not an experienced bank auditor, and by that admission he is disqualified from coming in and offering any opinion that would be entitled to any weight regarding the sufficiency of audit documentation under AS number 3, because he's not an experienced auditor in the banking industry, which is exactly what AS number 3 contemplates. And Ms. Jonigan's testimony with respect to documentation is therefore in effect unrebutted.
Thank you very much. Is there any questions? Okay.
Thank you.
Thank you. The commission will take this matter under advisement. Let me thank counsel for their arguments. Very well done and very helpful. We are adjourned. Thank you.